Stock market is seeing one of its best weeks of 2024, and interestingly, this comes less than 2 weeks after the stock market saw its worst day in 2 years. Last Monday, the Dow Jones fell by more than 1,000 points when everybody said that we're entering a recession. Now it feels like Wall Street has flipped the script, saying the recession is canceled, especially after what Walmart said yesterday. Walmart released their earnings statement yesterday, and what they said is that they made more money than expected. And the reason why they made more money than expected is because, number one, more people are shopping at Walmart. People are buying more value items at Walmart. And number three, what they said, this is the kicker, that they're seeing more upper income households shop at Walmart due to its, quote, value convenience proposition. Let me read you directly from what the chief financial officer of Walmart had to say about this, quote, "We know that our customers are looking for value and their dollars are stretched because of inflation. These customers are focusing in on those things that are providing value for them, aka shopping at Walmart because Walmart has those value deals. And customers are being choiceful when they buy the larger ticket items. In other words, Walmart understands that people are feeling the pinch of inflation, and that's why more people are turning to Walmart, which has been benefiting them. But the real reason why Wall Street liked the story is because Walmart said that they're making more money, not just because they're selling their stuff for more dollars, meaning inflation, but because Walmart said that they're selling more items to their customers. So Wall Street is hoping that this means people still have money to spend to keep the economy moving. But it's not just Walmart. We're also seeing spending boom in a different industry. Now, if you've been watching my videos or you're subscribed to Market Briefs, my free financial newsletter, you know that the Federal Reserve Bank has hinted at cutting interest rates this September. And in anticipation of the Federal Reserve Bank cutting interest rates, we've also seen mortgage rates fall in the last week or 2 weeks. And that has created a boom in people applying to get a mortgage and applying to refinance their mortgage. In just the last week, we have seen mortgage purchase applications jump up by 16% in 1 week. We've seen mortgage refinance applications jump up by 35% in just 1 week. And in the last year, we have seen mortgage refinance applications jump up by 118% because people are taking advantage of this little drop in mortgage rates. And this is before the Federal Reserve Bank has even begun to start cutting interest rates. Now, the reason why Wall Street loves this is because if people are borrowing money, if you have equity in your home, because what we know is that home prices recently just broke another record high, which means if you own a home, especially if you bought your home more than a year ago, chances are you have some equity in your home. And now if you have this equity in your home and you do this cash out refinance, which clearly more and more people are doing, well, that means you might have some more cash in your pocket. Now, it's not really money, it's debt, but in our economic system, it doesn't really matter. You have this new debt in your pocket, which now you can spend. Maybe use that money to shop at Walmart. Maybe use the money to say, you know what, let's go back to Whole Foods. Maybe use this money to buy some extra guac. Maybe use this money to go on a vacation. But at the end of the day, it's more dollars in the hands of people's pockets, which means people might be spending more money, assuming interest rates fall again. Now, if you haven't joined Market Briefs yet, it's my free financial newsletter where every day my team is working to break down what's happening in the economy, the housing market, the stock market, crypto, and the global economy into a fun reading, easy to read newsletter. You can read it in less than 5 minutes every morning and it's completely free. If you want to join Market Briefs, I got the link for you down in the description below. But the reason why this is interesting is because if you've been following what's going on with inflation, some of the biggest or hottest inflation numbers still today are housing costs, shelter costs, rental costs. And the housing costs make up one of the largest pieces of CPI, our inflation number. And it's also one of the most sensitive to interest rates. When interest rates go up, less people buy a home. That's why less people have been interested in buying a home earlier this year compared to 2021, because in 2021, you could get a mortgage for 3.5%. When mortgages were 7%, less people wanted to buy a home. So now, let's play the scenario out. Let's assume that the Federal Reserve Bank starts cutting interest rates and mortgage rates begin to fall. We've already seen this jump in refinancing applications and mortgage purchase applications, but if more people then start to go out to buy a home and we start to see more demand to buy a home, what's next? Maybe we start to see more bidding wars on homes again. And if now we start to see more bidding wars, that means buyers have to compete against each other to buy a home. And if you start to see more bidding wars, you might start to see home prices start to move up again. It's good if you own a home. Not so great if you're trying to buy a home, but maybe you can get a cheaper mortgage. But if you focus in on the inflation problem, what does that mean? Well, remember, one of the biggest pieces of CPI, our inflation data, is housing costs. So if we start cutting interest rates, more people start buying homes, and you start to see more bidding wars, and home prices start to go up, well, then that could make the inflation problem worse. And you can start to see why that's a big problem, because the Federal Reserve Bank has been working for the last 18 months to raise interest rates, keep interest rates high to bring inflation down. And yes, the interest rate or inflation rate has fallen since 2022. But that doesn't mean that inflation has fallen. I mean, remember, inflation compounds. Inflation is the prices of things rising. I mean, it's actually the value of a dollar dropping, but in essence, that causes the prices of things to go up. And inflation compounds. That means that the high inflation that we saw in 2021 was then compounded by the high inflation that we saw in 2022, which was then compounded by the high inflation in 2023, which was then compounded by the high inflation in 2024. Now, we haven't come down to 2% inflation. The Federal Reserve Bank says they want to see 2% inflation, but now they're saying that they don't want to start cutting interest rates when they see 2% inflation. They want to start cutting interest rates when they think that we're heading towards 2% inflation. And now, because they feel like we're heading towards 2% inflation, it seems like they're getting ready to start cutting interest rates. But the concern is, what happens if you start cutting interest rates and inflation starts to go back up? Then what do? Are you going to reverse course and raise interest rates again? Or are you going to continue working to stimulate the economy? Remember, this was the dilemma that the Federal Reserve Bank has been talking about for a long time. What's more important? Is it inflation or is it the economy? And we know that raising interest rates has consequences. I mean, we've really just begun to scratch the surface. But higher interest rates mean that businesses who borrow money have to pay higher interest rates. Not just because you borrow more money at higher interest rates, but because the money you borrowed previously is going to readjust. See, businesses and corporations, they don't get 30-year fixed rate mortgages. You get 3-year, 4-year, 5-year, 6-year, 7-year loans that readjust. And we're starting to see those corporate debts start to readjust. We're starting to see those commercial real estate loans start to readjust. And the fastest growing expense for the United States government is also net interest expenses, meaning the fastest growing expense for the government right now is paying back its debt. The government is going to spend more money this year paying back its debt than it will on spending money in the military. That's why you want to pay attention to what's going on with the Federal Reserve Bank and interest rates, because that ultimately is a big driver of what's happening in our economy, because we live in a spending-based economy. The more money you spend, the more money somebody else makes. If you make $50,000 a year and you lived in a cash-based economy, that means the most that you could spend is $50,000. Now, if you're financially smart, you're not going to spend all $50,000. You might spend $35,000 to $40,000. That way you can save and invest the rest of it. But that's not what happens. We live in a credit-based economy. What that means is you make $50,000, and then you have the ability to spend $80,000, because now you can use credit cards, you can use lines of credit, and you can use other forms of debt. Now, that's not always good for you. Sure, you could use that debt to buy income-producing assets, but that's not what the average American is doing. The average American is using debt to buy things that make them look rich, which really just keeps them poor while somebody else gets rich. When you go out to finance the BMW is getting rich, the car salesperson is getting rich, the bank is getting rich, you look rich, but you're really just the person that's making everybody else rich at the expense of you staying broke. And this is where you got to understand the difference between spending to make yourself rich and spending to look like you're rich, because Americans love to spend money to look like they're rich, but the reality is if you want to get rich, you can't keep spending money to look like you're rich. And that's the big dilemma, because we're not given that financial education on what to do. We're just told to get a good job, make some money, maybe put a little bit of money into your 401k if you're lucky, and then enjoy life. YOLO, buy some nice things. But the reality is, if you want to build wealth, you can't keep doing what the majority of people do. You got to start thinking a little bit differently, and you have to use your money differently, which is hard, because that means you're going to have to make some financial sacrifices, especially if you didn't have a lot of financial education to begin with. Now, what we have today is that inflation, the latest CPI data came in at 2.9%. This is from the data that we got this week. Core inflation came in a little bit above 3.2%. Now, core inflation, remember, is the number that the Federal Reserve Bank likes to look at. Core inflation is when you take the headline inflation number and you remove what they call the volatile numbers, which means the Federal Reserve Bank takes inflation across a broad spectrum of items. They remove the inflation from food, they remove the inflation from energy costs, and that's what the Federal Reserve Bank likes to look at. Why do they do that? Because the Federal Reserve Bank says the food inflation and energy inflation is a little bit too volatile for their liking, so they don't like to look at those numbers. Well, that core inflation is over 3%. CPI came in at 2.9%. The Federal Reserve Bank says they want to see 2% inflation, but we're not there. Now, what I'd like you to ask and think about here is, why does the Federal Reserve Bank want 2% inflation? Why not 3% inflation? Actually, why not 1% inflation or 0% inflation? In fact, why not negative 5% inflation to correct for the big price jumps that we have seen over the last 3 years? And the reason why is because the Federal Reserve Bank believes that 2% inflation is low enough not to impact consumers on a day-to-day level. Because if it's 2% inflation, you might not notice a 2% price growth in things in 1 year. And maybe if you look at it over the scope of 10 years, now you start to notice it, but the average person doesn't really pay attention to the price of things over the course of 10 years. And this is where I want you to get a little bit more financially smart. Inflation is going to stay around. The amount of inflation, the rate of inflation is going to fluctuate. Some years are going to be higher, some years are going to be lower. Lower interest rates can lead to higher inflation. But that doesn't really matter. What we know is that inflation is going to exist. The Federal Reserve Bank wants inflation. The government wants inflation. The government wants inflation because that's making their $35 trillion worth of national debt a little bit cheaper, because you can inflate away the value of that debt. Inflation makes the value of the dollar cheaper, so when you have so much debt, inflation makes that debt less expensive. Deflation, which is good for consumers, which makes it that your dollar is stronger, would make your debt more expensive. So the government wants inflation because that makes their debt a little bit less expensive. The Federal Reserve Bank wants inflation because that's what's going to stimulate the markets. That's what's going to stimulate the economy. The average person doesn't. Inflation is not good for consumers because inflation means you got to spend more dollars to buy your guac. Inflation is great for investors because that has fueled investment prices over the last number of years. So what this means for you is, if you want to build wealth in this economic system, you have to understand how the economic system works. You have to learn how you can build wealth. You have to pay attention to what's happening and then be able to capitalize on economic trends. But that requires you to, number one, use your money smartly. That way you have money to invest. You have to be an investor if you want to build wealth. Then you have to build your financial education. Learn how to analyze investments. Learn what's an undervalued investment. Learn how to read financial statements, a balance sheet, a cash flow statement, an income statement. Learn the different ways that you can invest, your investment strategies. And then pay attention to what's happening in terms of financial trends. See where the money is flowing. That way you can capitalize on investment opportunities because you're paying attention to what's happening in the markets. You have to be an investor if you want to win in this economic system, but that's going to require you to go out of your way to start investing in your financial education, because people are not going to do it for you. And with that, I'll see you all tomorrow.